Market confidence just took a hit. And it's not because of something the Fed said or this inflation report the market got today or something Trump did. It's something much quieter going on behind the scenes. It's regional banks. And based on last time they were in the spotlight, it didn't turn out very good, so I bet you could see where we're going. In fact, this news we're about to talk about caused the market to slip today. The Dow fell about 0.65%, the S&P 500 fell 0.63%, the Nasdaq in the red about 0.5%, all led by regional banks. So look at this top left chart up there. You see that? That's the KBW Regional Banking Index, and it plunged more than 6% today. We're talking about an index falling 6% in a single day. So what ended up happening is Zions Bank Corp revealed a $50 million charge-off tied to borrowers facing legal action. They're trying to recover more than $60 million it had lent out to investment funds Cantor 2 and Cantor 4, which the funds had turned around and used the revolving credit facilities to purchase distressed commercial mortgage loans, which the commercial space has been in crap and is expected to be in crap for quite a while longer, that commercial real estate space. Western Alliance followed up by confirming it's suing one of its borrowers for alleged fraud and is seeking to recover roughly $100 million from, this is a familiar name, Cantor Group 5. So that's not looking good. And even with the larger banks kicking off the week with strong earnings, they're talking about how well that upper cohort's doing and how consumers are still spending. They couldn't escape this damage either. We've seen Bank of America and Citigroup both sank today. Their stocks tumbled 3.5%. We've seen Jefferies fall 11% amid questions surrounding its ties to the now collapsed First Brands Auto Parts Group. There's just been a lot of anxiety about more potential credit blowups after the collapse of First Brands and Tricolor, which has raised broader questions about underwriting standards and whether or not this car market's in a bubble, with cars hitting now $50,000 on average for the first time in history. And this comes right after the warning we got from Jamie Dimon, JP Morgan Chase, that guy from Chase. He said, whenever you see one cockroach, there's more. So it's almost like we should have just expected this and maybe can continue to expect a little bit more fallout from this, but we'll just see. So the sell-off that we've seen caused investors to really flock for safety. And there's a few different main safeties. There's Bitcoin, if you will. That one's a little newer, not a whole lot of history. There's gold. Gold's been doing phenomenal. This one that's been unpopular for quite a while is U.S. Treasuries. So U.S. Treasury prices climbed. And if you look at the screen real quick, right here, what we see is that the Treasury yield for the 10-year Treasury has dropped to 3.97%. This is its lowest level since last October. So it's been quite a while since we've been here. And when the price of Treasuries go up, the yield goes down. While stocks wiggle and these treasuries are being scooped up, there's this question about a potential massive shift happening underneath the surface, which are cash and people's allocations of cash. These percentages of cash people are holding, mainly in terms of money markets. And JP Morgan says money market fund balances just hit a record $7.6 trillion. That's a trillion with a capital T. Time out, y'all. That's a lot of money. And despite rate cuts resuming, investors aren't really in this hurry to leave the safety of those funds. Only about $800 billion of that cash is considered flight risk, and that's mostly retail money. So what this means is that most of the market's money isn't looking for much action. Rather, it's just looking for this safe place to hang out, relax, kick it with its friends, have a good time, not necessarily chasing any risk right now. So even if the Fed does continue cutting rates, JP Morgan says yields on cash and bonds will stay about the same throughout next year, leaving little incentive to chase any additional risks associated with these assets all-time highs. So while everybody's asking and wondering when that cash will flock back into stocks and push them higher, the real question is, why would it do that when inflation's sticky, valuations are stretched, confidence in regional banks just took another punch, and that's not even going through the countless other things on the list layered on this cake that can be viewed as negative Nancy's in the way of things going pretty well. And then meanwhile, today, Fed Governor Christopher Waller came out and he backed another rate cut later this month, but said policymakers need to move with care. That phrase, move with care, might be one of the best summaries we've have of markets right now with where they are, and they should be what we're doing, moving with care. Fed officials are stuck in a strange spot. The economy looks strong, but the labor market looks weak. Waller calls it something's gotta give. Either growth slows down to match a soft job market, or jobs rebound to match the stronger GDP numbers. But it's iffy, it's weird, and that's also why Fed Chair Jerome Powell's decision to end quantitative tightening may not be as bullish as a lot of people think it would signal. So history shows that stocks often perform better when the Fed is draining liquidity from the market, not necessarily pumping it in. But when QT stops that quantitative tightening, it usually means the economy is slowing. And you can see that right here in this chart, where we see recessions as there's a QE, quantitative easing is what it's called. And then on top of that, the US just logged another staggering fiscal year at a $1.76 trillion deficit. That's a capital T, timeout, y'all. That's a lot of money. Slightly smaller than last year's, but it's still massive in ways that we can't even comprehend. Imagine like how much money that actually is. Like, you literally can't. So the national debt now has climbed to nearly $38 trillion, with interest payments topping $1 trillion. Now more than we spend on the defense budget. Yes, higher tariffs help bring in record customs revenue, but the overall math still doesn't balance. We're still out of whack, and that's the reality we're continuing to head into as we kick the can down the road. Slower growth, higher debt costs, and a Fed that's nearly out of answers, I guess. So what this shows is a market that's at odds with itself. Strong profits and weak confidence, cash hoarding alongside record highs for asset values. It's a mouthful, everybody, and I get it. And I like Amazon's slogan, every day's day one. We don't know where we're heading to. So in the meantime, y'all, I just hope your day is awesome. I hope you have a good one, and I hope you're back tomorrow so we can talk about what happened.